This is a working session, and by the end of this training, you'll understand exactly what happens to a loan file after the client walks into our office. So what you can do today is to help your deals close faster with fewer surprises. You bring in your client, we bring the financing options. So the stronger our processing gets together, the better the outcome for everyone in this training session today. So my agenda, I know there are 12 things to cover, but I'm going to focus on the critical things, and I can just bypass some of the information that I covered last time. But if you have any questions, we can always stop and deep dive. So we'll start with a mindset, then pass off the processing where the file is stuck and why, and the 4 pillars of why the loan decision: credit, income, asset, and property. And we'll cover the AUS findings, the automated underwriting engine, and we'll talk about the packaging of the file, processing, and underwriting. And we're going to close with roles and responsibilities so everyone knows who owns what. And I'll pause for questions for each major sections. So hold the questions and ask all at the last minute. The goal is simple. When we complete this training today, we'll have a better advocate for our buyers, and you'll know what lenders to send the files and what they're actually looking for. So let me start with something that might surprise you the most. The loans don't fall and they don't cancel because of the borrower. They fall apart because of the process. Specifically, the handoff between the sales team, the loan officer, and the operations, the loan processor. So loans do not fall apart in underwriting. The reasons why they fall apart in the handoff is because the mindset that the loan officer had and the processors had were not on the same page. Number one, confident is the issue. When a loan officer has done the work correctly, they don't hope for the loans to get approved. They know it all will. That confidence comes from preparation, not luck. Number two, successful. The success in lending isn't talent. I strongly believe it's a standardized process that eliminates surprises before they even happen. Number three, the knowledge. Our loan officers think like underwriters from day one, or we expect our loan officers to share the same vision as underwriters. Guidelines are understood, deals structured correctly before it gets even submitted. So our mission statement is to tell the full story on day one so clearly that the file stands on its own without your needing to be in the room. So why does it matter? Because when your borrower files prepared for today, closings happen on time. But if it's not, you get the call 3 days before closing at 11th hour that something's missing or going wrong. So let's walk through the life cycle of a loan. It starts with a lead generation, goes into application, and you gather documents and steps within the documentation, and pre-approval and pre-qualification goes out, and the pass off from loan officer to operations, processing, submission desk, and loan officer assistant. And this is the most common point of failures in lending. Why? Because of these root causes. Lack of SOP, no standardized operation procedures, because every LO thinks differently. So the operations never know what to expect. We talked about simplifying the communication channel so we don't have to confuse ourselves. So this relates to the SOPs. Second, the poor communications in between the team members with unclear expectations, loan officers and processors and assistant talking all 3 different languages, and things will fall apart through these cracks. And number 3, low trust. When the operations doesn't trust the file quality, when the processors think whether the Photoshop's bank statement or steps are coming in, when the underwriters see the outdated documents, outdated pay stubs, outdated mortgage statements, and these operations will start double doubting and start double checking every single document. And this slows the whole pipeline down. And number 4, insufficient training, where the team members and the team leaders don't talk to each other, and they don't think like underwriters. So they miss issues a trained eye would catch on day one. So what I want to point out today is when your buyer gets pre-approved, especially with our loan officers, we are not just running numbers through calculators. We are building a case file that has a hold up to the security. So we build from the bottom to the top. The stronger the file is on day one, the lesser chaos there is between contract and closing. So we can start closing in 10 to 14 days. So these are the checklists so that you can have a successful pass off. So what if you have a complete file actually look like this? 5 things we verify before any files move forward from our loan officers to our processors. Number 1, complete loan application. Full names, 2 years of address history, 2 years of employment history, no gaps, no shortcuts. Even if if there's a sufficient explanations, we can fill in the gaps. Number 2, credit reviewed. Underwriters, like underwriters, not just credit scores, but credit history and trade line histories, where every liabilities are analyzed and every dispute is addressed, every inquiry is explained, so that we can proceed and submit the file instead of holding on to the file, asking for additional steps. And third, when income reviews part is talked about, calculations are supporting the pay stubs, W-10 tax returns. The math tells a clear, consistent stories. Number 4, asset confirmed. Funds to close are sourced and documented. Large deposits explained, no mysteries money found. And number 5, AUS findings documented. Automated underwriting has been read and matched the file exactly. So when A type property is submitted with a B borrower, only these 2 information should be in the AUS. We shall not and will not add third borrower or a different property for the same AUS findings. Problems with loan officers is to hand out so many TBD pre-approval letters. Problem with realtors is that we don't have time to wait for the loan officers to create a customized pre-approval letter or customized AUS findings. That's why we fail. That's why the cracks are getting wider and problems come up. I want to emphasize that the rule is very simple. A partial file is not completed file is not ready to submit. We do not move forward until every box is checked. For us to close faster, for you to win a satisfaction guarantee transactions. Underlying principle here is that data consistency is everything. Name, addresses, social security numbers, employers, they must match perfectly across every document. Every name discrepancy, wrong middle name, wrong mailing address, wrong company name between a pay stub and a tax returns on a loan applications to W-2 can trigger a condition that costs numbers of delays. And for you guys, as a realtor, if you tell your buyer is a pre-qualified buyer when you submit an offer, this is a standard we hold ourselves to. Imagine they're your listing agent. Wouldn't you appreciate a buyer's agent submitting a full package on day 1 instead of sending in multiple small messages or emails? As you don't consider one of these incomplete purchase offers, please treat us like the same way. We do not and will not accept multiple small, many emails or messages. One email with all the steps. It's not a soft pre-qual based on the phone call. It's a ready file, ready underwritten, pre-approved loan. Okay? So this is my workflow on a day 0. When I catch this on day 0, not on day 20, then I can guarantee the funding and closing. Every issue we found early is the problem we control. Every issue the underwriter finds first is a problem that controls us. So 4 things that I want to check immediately is number 1, address search. Surprisingly, loan officers don't provide the specific property address, whether it's street, avenue, or lane. You'll be very surprised that the loan application address search, the names are mismatching. The Zillow shows north as a direction, but tax assessor has no directional indicator. So we don't know where to begin with. For FHA loans, for example, there is a 90 to 180 day flip rule applies. For example, the property sold lesser than 90 days ago, it's not eligible for FHA, but because of a lack of training, we loan officers incorrectly guide them, pre-qualify them using FHA, and we know at the last minute that it's not going to happen with this specific property. And full 2-year history, every month of employment and residency accounted for Any gaps need an explanation. Non-negotiable for most loan programs. And full legal name, for example, Mike instead of Michael, match the ID exactly. A name mismatch requires a redisclosure. Sometimes we have to repull the credit. So that costs time and money at the same time. Accurate asset information. Account types, balances, ownership must be confirmed. If it's co-owned by the spouse, we need to receive a 100% access letter. And large deposits greater than 50% of your income are flagged automatically and should be documented immediately. And every red flags we watch for are the recent address changes within 24 months, any name variance on the credit report, any name change because of a green card or citizenship application, missing employment dates especially comes into play where the companies merge. So headquarters showing Texas, but physical location of the business is in California, Santa Ana, California. This better be showing on the application. Please do not rely on us. Play detective and find out. This is impacting your closing date. Okay? So pro tip here is the best time to fix a problem is before the underwriter sees it, before you submit the file, before the processor touches the file. Sales team must pre-review, pre-certify every document, every information before it submits it. So if your buyer asks for whether they should be moving money around or open a new bank account, the answer is and should be call us first. Never say yes or no from your end. You don't know what kind of account or what kind of information that you need to release to. Even if you know it, please run it by us. Sometimes you'll be very surprised that overcome that fund issue, source of down payment issue using a gift. So let's assume that we became the credit detective. Loan officer failed to provide all the information, or intentionally hiding information through credit repair agencies or whatever. Something happened and we found it. Then what do we do, right? So this is the major issue where the pre-qualifications fall apart silently. When the borrowers most think about the credit, they think about just the score. They send you the screenshot of a bank account or credit account, and they expect you to use it. But a score is just a number. What matters is what's behind it. We train our loan officers to search every credit report for 12 specific items that I just mentioned here. Directly impact DTI, capacity, spending limit, and eligibility. And debt-related, the lease obligations, the deferred student loans, the real estate ownership percentage, and the HELOC or equity lines. And derogatory lines, charge-offs, collections, foreclosures and bankruptcies, and special status like disputed accounts, fraud alerts, balance transfers, and authorized user accounts. Everything comes into play. And from my experience, 3 things come up the most. Number 1 was the student loans. Even if it's deferred, they may still count against the DTI, depending on the program. So are we sending it to Fannie Mae or Freddie Mac, or FHA or VA or USDA? We calculate the student loan liabilities differently. They are all different. And second, authorized user accounts. Your buyer may be on someone else's credit card. If the primary cardholder defaults, it shows on your buyer's report. Has to be handled before underwriting, right? But you don't want to demand the loan officer that they're going to pull the credit at the offer acceptance date. That doesn't make any sense. Why are you hedging your buyer's money, their credibility, their money for something greater like this? And third, disputed account showing the credit report. When you see or when you hear from us that there is an open dispute that can invalidate the AUS approval entirely, we have to stop, unfortunately, and we have to address the disputes before we get into a decision-making situation. We are not going to allow our buyers to wire the EMD and see them losing the EMD because of the mistake, because of miscommunications, because of indifferences. I understand how difficult it is to encourage the buyers to put an offer in. But at the same time, why put this in an urge to even canceling a file, right? So when a buyer mentions that they're disputing something on the credit report, tell them to call us before they do anything. We have to run the AUS and find out eligibility. Timing and method matter afterwards, okay? There are 4 things. There are 4 credit rules you must know. And 4 specific credit rules every realtor should understand. at the high level. The rule number one is the frozen credit. When a credit freeze is an immediate stop, right? Unfreezing takes about a day or two, so which delays the pre-qualification and may lead into, can lock a rate expiration as well. If your buyer has a freeze in place, you have to let them know to unfreeze before we pull the credit. And rule number two, FHA lesser than 10 months rule. When a debt has a lesser than 10 months remaining, must be counted if the payment exceeds 5% of a gross monthly income. So for example, conventional loan doesn't specify this, but FHA verifies the payment exceeding the 5% of a gross income. They verify and they compare. So you may say, why is this company with conventional lending approves the loan, whereas this company with FHA does not approve the loan? Buyers are often surprised when the nearly paid off debt still counts for the debt to income ratio. Rule number three, disputed accounts. Disputes can invalidate the AUS approval. Most must be removed before we get to, underwriting decision. So we check the AUS findings immediately and document everything. There's no what if situation. If you need to and expect faster closing, you have to allow us to run the AUS. Rule number four, authorized user accounts. If the primary cardholder has missed payments, it may appear on your buyer's report. AUS may require proof that they are not responsible. We may able to exclude the debt if we can show the 12 months of payment by the primary owner. So if there's any one missing payment or consecutive missing payments and impacting our credit's derogatories, we have to stop the underwriting. We have to stop the AUS findings and then go back. Worst case is to pull the authorized user account out from the credit and rerun the credit. So don't guess, verify. When in doubt about a trade line, we run the AUS. So the findings report tells us exactly what conditions will be required. So when we talk about the income, this is where I see the most confusion from the borrowers and honestly from the lenders who don't do the thorough work. Why are the lenders underwriter give us different income every single time, right? This is not just a number. I think it's a narrative. Underwriters don't just calculate with the paperwork. They analyze the stability and the cash flow, and the likelihood that the income will continue. We build an income story from the three pillars. First is a history, where has the borrower worked, how many years, how long, any employment gaps needing to explanation. 2 years is a standard benchmark, but if you see anything lesser, if you see any, puzzle pieces that's different than the ordinary 2-year standard, then you have to pause and double check this portion before you proceed. And second, the frequency. How are they paid? Weekly, bi-weekly, monthly, base salary, overtime, bonuses, commissions. A buyer earns about $3,000 bi-weekly is not the same as one earning $3,000 monthly. We calculated it correctly for the specific pay structure. And lastly, the trending is income increasing or stable or declining year over year. Declining income is a major red flag. Even the current number looks really good. For self-employed, when they made $90,000 last year and $75,000 this year, that trend matters to underwriters. So why behind the math needs to be explained. We loan officers and the realtors need to know how to explain the pay variances clearly in the file. Is it hourly wage? Is it salary wage? Or is it base pay plus RSU? You have to find out by asking additional documents. And ensure the consistency across the verification of employment, pay stub and W-2s. What I see the most is W-2 showing $100,000 and pay stub base salary starting from $80,000. So finding out the missing puzzle of $20,000 takes the most time. So I encourage all of us not to waste additional time on the missing puzzle. Just ask everything upfront on day one. If you don't know, please ask us. It's better to ask us and send out a complete checklist than going back and forth. Not only we make the buyers tired, but our company's workflow and the pipeline will be delayed as well. And third, prepared underwriter ready calculation for the variable income. bonuses, commissions, overtime are included. So if your buyer is self-employed, commission-based, or has a second job, or recently changed careers, that flags us. So it's not the deal breaker. Truthfully, it's not. But they need more documentation and more time upfront. And let's talk about the employment gaps. The gaps in employment happen. Life happens, right? The question isn't whether there is a gap. It's how we explain and document it. 6 gap scenarios and how we handle each. Number 1, a mom returning to work, common after maternity leave. So we document the return date and the confirmed guaranteed hours within the employer. And second, recent graduate. The reason why spring market is hotter than any other market is because of these recent graduates as well. Transcripts can count as work history under the 2-year rule. Must show the degree completion for 4-year college and a copy of a transcript. And third, caregiver and sick leave. The medical and family leave is acceptable. It is acceptable, so simple letter of explanation, LOE, is good enough. We don't have to complicate the things. When the gap is lesser than 12 months, we can give you automatic approval. When the gap is greater than 12 months, then the medical leave or family death or incident must be verified, and doctor's note or medical record must provide as a proof of evidence. Layoffs. Involuntary unemployment is understandable. We focus on the re-employment stability. If the new job is from the same field with consistent income and time in current role, then we'll be able to take it. Seasonal work, like movie stars or football players or any of those who's making very few months of income for the entire year, must show the 2-year history of returning each season. It should be a contract. It could be an employment agreement. So the unemployment income from the off-season also counts. Documentation rule. Any gap longer than 30 days require a written letter of explanation, and we coach borrowers through it. It's not a scary moment, but it must be done proactively on time before we pass the deadline. So I want to focus on the 2 special cases that comes the most. FHA self-employment, when typically 2 years of tax returns are required, and 1 year may be allowed if the borrower was in the same field for the work for the 2 or more years prior to going self-employed. Okay? And second, delinquent federal tax liens. This applies to all the loans, requires a valid payment plan with a proof of 3 consecutive payment schedules. So for right now, year 2025, taxable income can be calculated for qualification. And on the page 2, when you see a payment due, before you send the file to us, please ask your borrowers if they had made the payment in full or in payment plan. If they agree to do the payment plan today, then they cannot apply until the 3rd payment is processed. So if the first payment is starting on April 2026, 1, 2, 3, April, May, June. So we can maybe start the loan on June and fund on July. There's no other exception. So make sure your borrower is fully aware what this means. And for you guys too, if your buyer has a gap, don't let them hide it. Explanation is the same and not the same as it is qualification. So let's talk about the asset. Investigate the capacity. How much can we use and how much cannot use? The assets are the number 1 source of underwriting conditions, and most of them are completely avoidable. So when you see all these things, starting from analyzing all statements, full pages of the 2-month bank statements and retirement statements, or whatever the asset document that we need to use, just read them through. And when you don't see the summary or the story within the bank statement, then send it to us. But if you see anything popping, anything that's indifferent than the other, underwriters look every transaction too. So why find out the problem after the couple days or weeks later? If you can do it today, you should. It will help you how to do this. It wouldn't take more than 5 minutes. And second, the source large deposits also come into play. Any non-payroll deposit exceeding 50% of the monthly income must be documented. Is it gift? Is it asset sale? Is it tax refund, we document it upfront. And third, verify the ownership and the access. So within the file, borrower names must appear on the account. Joint account or family account require access letters. And number four, FHA gift documentation. Unlike the conventional loan, FHA requires a gift letter, proof of transfer, and the documentation of donor's ability to give. So we need donor's bank statement as well. All three. There's no exception. There's no shortcuts. Okay. And lastly, align reserves to AUS. So after down payment and closing costs is annualized, our must have the reserves to AUS requirement. So for example, FHA unit transactions require 2 months. Conventional investment transactions require reserves. Owner occupied, cash out, refinance with debt to income above 45% requires reserve. So these indicators must be and better be equipped so that we don't give out a wrong qualification details, wrong pricing, and wrong expectation. So if your buyer mentions about cash at home, any large deposit from a family member or recent asset sale, any watch, yacht, boat, whatever that comes into play, that conversation needs to happen with us before we build a file, before we submit the file, before we pre-underwrite the file, not after. So these two come into play every single time. And I don't want us to work outside the box. I always want to provide plan B and C in the worst case scenario. And I want all of us to think it this way. So we never fail. Our success ratio is 100%. It's because we don't collect any steps on a loan scenario that doesn't work, that doesn't apply. So we want to know why and how this can happen every single transaction. Cash on hand. This is the most critical thing that comes. So when you have a cash only borrowers, home ready and home possible, the AMI 80% or below can also apply. So the current counties or one of these subject properties that has a sales price under $300,000 can be applied with this product at this time, realistically. So even then, we must show the consistent history of saving cash at home. It could be like a ledger, it could be an Excel file. And second, a new bank account must be opened within 30 days of applications, and funds must not be being borrowed from another party. It's not a repayment. It needs to be deposited, okay? And fourth, borrower must show limited or no use of a traditional credit. So this is not a workaround. It is a legitimate option for a specific borrower profile and has to be documented correctly. And when we deal with a sale of personal asset, selling a car, boat, or valuable item to fund closing and the closing cost, we have to differentiate what is allowed and what is not. We need the proof of ownership and the value. We need the registration, title, and or appraisal. And we need the transfer of ownership, bill of sale signed by both parties, or receipt of proceeds, copy of a check or deposit slip showing the funds hit the account are necessary to show that the funds are acceptable. So the sales price must be reasonable. We reference Kelly's Blue Book for vehicle, for example. If someone claims they sold a 2015 Honda for $40,000, that's going to be questioned. Please double check, use your common sense, and create the storytelling. And when the sales price must be and will be documented, and your buyer is, pulling the closing costs from multiple sources, from savings, gift, or 401ks or asset sale, please tell us, early in advance so we can structure it correctly and ask specific documents. The worst case is to find out after the file is already submitted. We don't want to revert it. Giving Tree charges $1,000 for resubmission fees. We charge this intentionally so loan officer's submission and the rate lock ratio is confirmed and suffice to continue loan submission. And second, as a wholesale team, we want to guarantee the best pricing options for all the files. We don't want to tell you that this is happening or that is happening because of our, the miscommunication or incorrect loan file submission. So we want to avoid that every possible way. So the collateral needs to be reviewed, right? So when we review the 4 pillars of a transaction, the fourth one comes with the appraisal. So when we talk about the appraisal report, where we talk about the condition and the safety red flags. Does the value support the loan amount? Are the photos consistent with the description? And the appraiser who notes deferred maintenance or safety issue can trigger the requirement repair before closing. And sometimes listing agents are just too kind. They want to tell the appraiser too much information about the relationship with the buyer and the seller, or the condition of the termite or not. We don't have to explain anything more than what the purchase agreement stated. But things happen, and a lot of the arms and lengths and non-arms and lengths transactions are found on the appraisal report. And you'll be very surprised. It's never too late to let them know to zip it. If we talk too much and accidentally leak one of these information, and these informations are written and reported through XML file through Fannie and Freddie Mac. So this is how the AMCs do. They receive the XML file, the typed version of our appraisal report, through a software, and they generate, process, and create it to PDF. In this processing moment, this XML file is also uploaded to Fannie Mae and bring us the risk management factor number. And this number better be lower than 1. But if it's sometimes 2, 2.5, and telling us that the risk assessment is necessary, showing, oh, this property was sales price is at 1 million, but the appraisal value shows 1 million with a risk number at 2. This means Fannie Mae doesn't like this $1 million appraisal value. Then we have to order another appraisal report or another desk review. Additional things may apply. So don't stretch too much. But if you don't know it and accidentally do it and found these findings after the deal is opened, after the deal is submitted, there's no one to blame to. And once these files are uploaded to Fannie Mae and recorded, even though we resubmit this file and send it to, let's say, Freddie Mac or other lenders or agencies, these numbers, Fannie Mae case number that we already registered through AMC, can be found. You'll be very surprised what kind of incomplete and untrained loan officer can jeopardize a purchase transaction by submitting loans multiple different lenders. I've seen it at least 2 to 3 times a week. So I want to have this time to make sure once the appraisal is ordered and appraisal report is received, I highly recommend to avoid resubmitting the file. It's a purchase loan. We don't want to damage the transaction as well. If it's a refinance file, it's a different story. But for the purchase transactions, must be dealt delicately with specific checklist. And the collateral document contains the condo documents as well. The HOA budget with 10% reserve is required as well. Active litigation check is needed. Owner occupancy ratio review must be done. And the condo complexity with too many rentals may not be warrantable through Fannie Mae, meaning we cannot finance it through conventional or FHA product. And homeowners insurance, this hazard insurance covering or flood zone determination over condos, master insurance, and master policy. So everything comes into play. We confirm whether it covers the walls in or walls out. It affects what the buyer needs for the individual policy at the same time. And lastly, the title commitment. When we receive the title report, existing lien or judgment or easement or encroachment or legal description on each line must match. Incompetent listing agent find out the problems, legal issues after the buyer accepts the offer. If I were the listing agent, I'll probably order the preliminary report in advance and read through what the heck's happening with this seller, and then do the discovery talk with the seller so that you don't have to cancel the escrow after every staging and the marketing has been done. I've seen it many times at this time too. A lot of litigation within the HOA is hidden. They are found through HOA certification or HOA board member meetings or bylaws, or HOA fee increase should be dealt, but it's not. So they find out in the middle of an escrow, and when the DTI changes, the deal gets canceled. Very unfortunate news are coming out at this time. So please make sure you triple check all these asset related documents before. And if you're the buyer agent, of course, demand these documents to your seller. And if the seller's agent tell you that we don't do this way, we don't operate that way, and that's an indicator where you can hook the most. Maybe work on the sales price, seller's credit, or etc. because that seller's agent was not complying the due diligence requirement. So as that incompetent seller's agent was busy focusing on sale of a property, they'll probably help us, the buyer's agent, to work on the numbers in advance. I want to reemphasize the FHA 90 to 180 day rule again. When the property is sold less than 90 days ago, it's not eligible for FHA, period. Please double check your MLS and double check the date of the sale. So some of the times you have to intentionally wait the loan application date after the 90th day for the FHA loan approval. And if the loan is sold within 91 to 180 days old, second appraiser will be required. And we check the Zillow, tax assessor site, and MLS. And the moment we find the address, we will triple check and issue yes or no. So before you write an FHA offer on a recently listed property or relisted property, please double check these findings. We can check the flip timeline within 60 seconds and save everyone's time. On this topic, I want to emphasize on the AUS. The decision engine behind every loan is coming from an automated underwriting system. And the most misunderstood tool in our business is this. Surprisingly, senior loan officers, especially the ones in California, are not trained to run AUS before the loan submission. So most people think the AUS is a pass-fail button, but it's not. AUS is an instruction manual. The systems we use by loan type goes by Fannie Mae with desktop underwriting, Freddie Mac with loan product advisor, FHA with total scorecard, VA with GUS or DU, USDA with GUS or GUS. So our 3-step AUS discipline comes with step 1, run it. Try to run it and find out what input data matches the document exactly or not. If not, rerun it every time material fact changes. LTV change, the income change, DTI change, property address change. Don't question, just run. When the new job comes, rerun, right? Different property, rerun. Paid off a debt, rerun. Got it? And second, read it. After you think you run the final DU, final versions of the DU, then don't just look over the approval eligible and move on. Continue reading. Read every condition. AUS is kind to tell you every exact conditions the underwriter is going to ask you for. Use that as your preparation checklist. And step 3, document it. Save the findings report on the file, name it, and then compare for other as well. Every condition listed must be addressed before pass off. No exceptions. When the AUS shows, oh, you need to verify this, you need to verify that. If you can submit all these and the steps asking from the AUS, then you can expect the closing in 7 to 10 days. You may question, hey, Peter, how many 7-day closing have you done? Or how many 10-day closing have you done? About 80% of the purchase transactions that I originate have the 7-day to 10-day closing. Because I don't work with every loan officer or I don't work with every realtor. Only the realtor who is hyper-intensive, hyper-focused gets to work with me, and I deliver my gratitude and thankfulness with faster closing, which means I lock in the rate on day 1, and on this lock-in date, I cleared all the income and asset condition. And second, we appraise. We order HOA certification, appraisal report, and third time we call, we're going to talk about the signing date and the funding date. Purchase loan shouldn't be a big deal. It's not a rocket science. It just becomes difficult and it becomes dragged because we start unprepared. Package the irresisting files. I want to just focus on the 4 elements. So when we submit the files, if you can, our processors are trained to do this on every single loan submission to underwriting department. We have this half page, like a cheat sheet, talk about the credit, income, asset, and collateral highlights. So the underwriter reads that first page and understands the full picture before reviewing additional documents. And second, the logical organizations, the documentations attached in order, labeled consistently, such as page 1 through 10, bank statement, page 11 through 13 as a pay stub, not jumbled up, not going back and forth, not in reverse order. So pay stubs labeled as pay stub, W-2 labeled as W-2. Just, 5-10 minutes of your renaming PDFs will save a lot of time. If you just dump all the PDFs into one and name as scan 001, it's your loss. You get the origination fee anyway. We get fixed fees. So we will follow through and provide you everything in timely manner. But if you need a faster approval, please send us pre-filtered, pre-labeled documentation. And third, file narrative comes into play and focus on the why. Why do we need to approve this loan? These upfront explanations for gaps, large deposits, credit inquiries must be written upfront. We explain before the underwriter has to ask, so that we can build trust and accelerate the file decisions faster and faster later on. So there's no guessing work for underwriting. Every number in application is supported by a document in file. So the underwriter never wonders where the figure is coming from. So when the underwriters and the processor have a great relationship, the job gets easier. When we submit the file clean, organized, and thoroughly explaining all these files, and they'll end up trusting us. Once the trust is built, then they move on to the files faster. You may wonder, why isn't this loan officer, why isn't this underwriter, why isn't this processor having so much of a hard time clearing one condition and delaying for 2 additional days? Because you provided everything but this for multiple times, now underwriter is just giving you a hard time. You don't have to be sorry about it, but this is it's industry standard. Wouldn't you do the same to the transaction coordinators, asking the same question or similar questions over and over again and not showing the proof of the growth and the, engagement? Would you really want to pay them and use them for next transactions if the miscommunication continuously happen? You provide the services, but at the same time, you have to work with reliable sources, reliable team members. So when you refer a buyer to us, or when you pre-qualify the buyer and submit the file to us, this is a standard of care they receive. Not, we'll figure it out in the underwriting approach. Never approach it that way. A fully prepared file before it's submitted helps us to develop relationships from there. So I want to specify clearly what roles and responsibilities that I expect as operations. So speed comes from clarity of ownership, right? So number one, loan originators are the structures. They're the architects. They structure the file and price out the loans. Client relationship, pre-qualifications, rate lock, deal structure, file narratives, LOEs, all come from sales team. You know the borrower the most, not us. We are not going to play detective. Don't make us to play detective. And second, loan partners such as loan officer assistant, who help within your team to set up the file, scrub the files, renaming the PDFs, are focusing on the document collection, verification of employment, and scrubbing. Basically, optimizing the documentation in the timely manner in the orientation so we can take care of it faster. So, and third, the processing team and the closer where we focus on the prior to doc conditions and funding, will focus on the conditioning, clearing information, and balancing the final fees, balancing CD for the title, and the coordinating the closing agent. So as a team, communication comes into play. We have to proactively participate and update the file, whether we own it or escalate it. It's not my job, and walk away. We don't do it, and we don't expect you to do it, or we don't expect you to experience anything like it. When the problems come up, we'll stop every conversation and we'll only dive into the solution. Once we have the solution, it's never too late to talk about what actually had happened. But don't say he said, she said, I didn't know, I was never told. If you want to share your commission to us, if you want to do 50-50 with us, then we are gladly accepting any of these. We do that too, don't get me wrong. Within GivingTree, we have a team leader, team company, and a team member. There is a team who's doing it 4 cuts from my pricing, but the members are very happy because they close every single transaction. What kind of a dimension, what kind of a direction are you going to take? I encourage everyone, especially at this time, to focus on overcoming the difficulties. Winter's been cold for too long. We thought the rate will go down later next month. But look at what's going on with Iran. they continuously bomb each other and delay the shipment with oil. So look at the 10-year bond today compared to 2 weeks ago. It's really difficult to engage with the today's rate. I mean, we talked about marry the house, date the rate, that kind of stuff. That intonation was very popular 3-4 years ago when the rates were going above 7 and 8. We once had the 10-year treasury bond above 5, but we don't have that nowadays, right? We don't have to carry that mindset. But if you compare what we had a month ago and today, we're having a hard time. But what we want to collectively have or create right now is to have a mindset to be ready for the spring market. So after the summer vacation, after the spring vacation is done, you have to anticipate to jump in. So be ready for the fast market that's around the corner. So when we have too many files, all these lines will blur. You may expect the loan processor to take the sales call, and we may expect the loan officer to collect the steps even before we do, including the homeowner's insurance or HOA certifications. Delays will come into play. Escrow and title companies will delay too. But that's where the teamwork comes into play. Responsibility does not blur. Someone always owns up the outcome of a file. And I always say, whomever gets paid the most has the biggest liability. So when you work with us, you have the named contact who owns the files within the ERP system. If something is going wrong, they fix it or escalate it immediately. So if you don't see any updates within the 24-hour term, that's where Brenda and I will jump in and assist. On your side, the best thing you can do is to set the clear expectations with the buyers with a timeline, document preparations, and communications. And more prepared the buyer is before they sit down with us, the faster the whole process will move. So takeaways. There are 5 takeaways that I want you to focus on that you can start acting today and tomorrow. Number 1, read through the credit report that you have. When your buyer mentions about any debt situation, car that's almost paid off, old collection 7-8 years ago that hasn't been handled, someone else's card sitting on it with a multiple late payments, send them to us. We'll dive in, going over line by line before the problems grow bigger. And second, I want you to start building a habit of writing a story. I mean, I know it's stopped legally, but the buyer's agent used to write a letter of the buyer explaining why the buyer must and wants to buy this house, right? The representation also, the technique also works with loan submission at the same time. Write us what the file is all about. Self-employed, commission-based, recently changed jobs. The earlier we know, the better we prepare the file. And number 3, verify every asset. Don't just commingle and say, we're going to use a gift, we're going to use this and that at the initial stage. Remind your buyers that we don't move money and we don't open new accounts. We don't apply new credit cards. Don't accept large transfers without calling us first. It's better not to receive any funds and receive them through gift so that we don't have to touch the operating account's income, cash flow. And 4, check the property early. If it's FHA buyer and recently relisted property, call us before you write the offer. We will check the flip timeline in minutes. And finally, the AUS. You may ask when we can get the pre-approval. Then we may ask you, did you run the AUS? To which program? What is the program name? What conditions were coming up? What questions do you have from the AUS? A strong pre-qualification and pre-approval is a documented pre-approval. So overall, what I want to emphasize is speed wins deals, accuracy keeps them. How we aim and shoot determines the outcome. So when the rates were in 2s and 3s, we were not trained to aim and shoot. We were busy shooting. And surprisingly, every single thing that we were shooting were able to collect. We were able to receive a lot of fruitful results. But at this time, we have to play a little bit differently. We have to train ourselves to aim before we shoot, so that every single try we do converts and transact into specific transactions. It could be purchase, it could be buyers, it could be listing opportunities. Okay?